Good morning and welcome to this Wednesday, May 18th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, another morning and another morning of red futures. Not horrible, but not very good either. We got Dow futures down about 0.75%, S&P 500 futures down about 1%, NASDAQ getting hit a little bit harder, down closer to 1.4%. We got crude oil up this morning, up nearly 2%, back to 114.50 per barrel. The 10-year Treasury yield up 3 basis points, right back to 3%. We got not great earnings. Most of the companies that reported last night or this morning are down with their earnings. A few of them had pretty good misses. One of them, probably the poster child for today, is going to be Target. It's almost like they had a target on their back. Didn't perform well and not getting a very good response. Target was expected to earn $3 a share, and they came in with $2.19. So they followed in the footsteps of Walmart yesterday. Walmart, big loser on the day. They had expected earnings come in at $1.46. They came in at $1.30. And both companies, Walmart and Target, both cited inflation and their higher costs, their supply chain issues. So that is not going away, or it hasn't gone away. And so, the inflation, I probably mistakenly referred to the ghost of inflation. Because it's not a ghost. It's definitely here. We've got companies having issues, and this is what inflation does. It eats away at profits. And that's why many of these growth stocks, in addition to the possibility of a recession, many of these growth stocks are getting hit for the same reason. Inflation eats away at future earnings. That earnings growth rate, those growth rates are not what they were a year or two ago. And honestly, they're not as meaningful when you've got inflation at this level. So the Fed's got its work cut out for it. As I've said before, I don't believe this is systemic. I don't think this is a long-term inflation issue, but I was wrong. It's definitely lasted longer than what I had originally thought it would. But as I've also said before, I don't have the pandemic playbook. We haven't had one of these in 100 years. I don't think too many folks really knew exactly what was going to happen. We've had crazy volatility, crazy rotation. I think some of that will begin to subside later this year and into next year. But I thought that last year as well, just being honest. I really thought by this year we would probably be beyond a lot of those issues, and they're still here. So we got to take this one day at a time. I am still very bullish longer term, as most of you probably know. But coming into this year, I was not bullish. I was very bearish. And I said it would be 3 to 6 months. We're not into the 6th month yet. So we'll see what happens the second half of the year. I think we'll pick up. I think the question for me is whether or not the Fed starts to give indications that they believe the inflation's under control. I think we're going to see inflation drop again next month. The annual rate should drop next month and the month after that, just because of the way the math works. And because things are just slowing down. I think we're starting to see it in earnings. We're seeing it in guidance forecasts. We've seen it for the last year in terms of sentiment, consumer sentiment. So anyway, this is the market we have. This is the hand we're dealt. This is what we're going to go with. So we'll just keep taking it one day at a time. I do want to mention this is option expiration week. We do have monthly options expiring on Friday. We had a really good Max Payne session last night. This is a crazy period because, on the one hand, I understand why you would be bearish. I mean, I'm bearish. Market's been straight down. Volatility's remained high. It's hard to be an aggressive player on the long side in this kind of a market. There's no doubt about it, especially if you're just a short-term trader. I mean, your alternative is to sit in cash, which is a pretty good alternative to going long. Now, you might say, well, why don't you short? And again, as I explained, in a cyclical bear market, especially after the market's already hit that 20% threshold, we could bottom and turn higher at any time. So I'm not really interested in trying to catch the last piece of this move down. If you think we're in a long-term secular bear market, go for it. stay with the shorts. If we are in a long-term secular bear market, shorting is the way to go, no doubt. I would personally wait for bounces. I would not be trying to short into weakness. I wouldn't try to chase these moves to the downside. You've seen some stocks rebound 20% or more in the last 3 or 4 days. So, just shorting at any time doesn't make sense either. You do have to wait for your spots, wait for rebounds, and then, slowly build your positions. But again, I'm not really in that camp. I like to go long. I would much rather be on the long side than the short side. That's just me personally, just my own psyche. Has nothing to do with being a perma bull. It's just knowing that the market goes up most of the time and not wanting to be on the short side when the market's going up. That to me is the worst position I could possibly be in emotionally. So I would rather, even if I'm bearish and I think we're going to turn lower, a lot of times I'm just in cash. And I look at it as though my buying power is increasing. If I'm sitting in cash, the market's going lower and prices are getting cheaper, I can buy more when I finally start getting in. So I'm fine with being in cash much of the time. Anyway, let's move on. I wanted to first talk a little bit about EarningsBeats for those of you who are new. First of all, I really want to just mention we have a 2-week spring special going on right now, and this is our best deal of the year. So if you like our service, if you like the guidance that we've provided, you like the research we do, all the educational events, the things we try to teach, now's the best time to lock in for the long term. So the deal gets better the longer you lock in. It's completely up to you, but 1 year gets you 2 months free, 2 years, 6 months free, 3 years will give you a full year free. That's 4 years for the price of 3. That would hopefully give you some peace of mind over the next 4 years, at least get my opinion on where I see the market going. I think we've been pretty accurate really over the last 3 years. It's been a trying period, especially all the volatility and the rotation, but just general market guidance, I don't know that there's been any better anywhere. And I'm just being honest. We were very bullish in 2020, even with the pandemic. We were very bullish in 2021. We kept going higher. We turned to bearish at the end of December. I mean, I don't know how it could be much better in terms of guidance. Anyhow, this is the reward. We do appreciate all of our members, everyone that supports us. And so we're giving back here, giving you an opportunity to really lock in some low prices. If you scroll down on the page, we have our free EarningsBeats Digest newsletter. This is the best way to get to know us. 3-day-a-week newsletter, Monday, Wednesday, Friday, comes out before the opening bell, usually about an hour before the opening bell, unless there's some extenuating circumstances. This is no credit card required. You can unsubscribe at any time. All it takes is a name and email address. Boom, done. We have many free events throughout the year for our digest community. We reach out, we give you room instructions so that you can come in. That's another benefit being on this list, is when we have free events, you're going to know about it and be able to plan accordingly. All right, let's talk a little bit about what happened yesterday. We saw a rally. Not crazy rally, but pretty darn good. We had the Dow Jones Industrial Average up 431, S&P 500 up 81, NASDAQ up 321. Nice to see a plus in front of these 300, 400, and 500 numbers. We've been seeing a lot of minuses with the NASDAQ, but NASDAQ did bounce pretty nicely yesterday. Mid caps up almost 3%, small caps slightly above 3%. So mid caps and small caps doing well. And notice both of these are right here at the 20-day moving average. When you look at our other major indices, we're not quite there yet. So at least relative to the 20-day, mid caps and small caps starting to show a little bit of strength there. From a sector perspective, technology, you want to know why NASDAQ did well? Well, technology was the leading sector yesterday. Up almost 3%, materials 2.8%, financials 2.7%, discretionary 2.5%, and staples was the worst performer. The only sector that was in negative territory yesterday, consumer staples, down about 0.7%. So for once, we actually saw a nice relationship between consumer discretionary and consumer staples. Now, I want to tell you the last time that we saw any kind of strength like this was back in mid-March during option expiration week. And if you think that's a coincidence, go ahead. You can think it's coincidence. I don't think it's coincidence. You get a lot of discretionary, a lot of technology stocks being hit hard going into option expiration week. There's a ton of in the money put premium. And back in March, that's where we had this big rally. See, discretionary stocks, huge rally. Technology, huge rally. I don't believe that was a coincidence. I think there were a lot of in the money put options, hardly any in the money call options at that time. So it behooved market makers to drive prices higher. In other words, they would make more money. Not going to lose money if it goes against them. I don't want you to think that, max pain means that there's a guarantee we're going one direction or the other. It's not. But it's kind of like, trying to think of a good analogy. I don't know, maybe holding up a piece of raw meat in front of a starving animal. I mean, that's kind of what, when you've got max pain well above current price, meaning that it would behoove market makers to drive prices higher. That's kind of what it's like to me. Market makers like to make money. I mean, market makers are these big Wall Street firms. We know they're a greedy bunch. Now, their job is to provide liquidity, but they not only provide liquidity, I mean, don't think they're all just great guys or gals because they provide liquidity. They also do their best to make money in their trading accounts, which guess what? Guess who that takes money away from? Folks on the other side of the trades. Market makers are great traders. And it always helps when you see the order flow ahead of time. Makes it a lot easier. They also have plenty of algorithms and so forth, knowing what traders are going to do with certain stops being triggered at different levels. I mean, they're very, very good and sophisticated traders. And when going into option expiration week that they have financial incentive for prices to move in one direction or the other, not saying it's going to happen. Sometimes they can't help it. The volume is so great. They don't have the capital to turn things around. But if the volume is just so, I would not bet against the market makers moving prices higher as we head maybe toward Friday. We'll see. But anyway, overall, pretty good day yesterday. Like I said, staples, the only sector to the downside. So 10 out of 11 rose in this market. And in 2022, we don't have too many of those days, so we'll take it. All right, let's move on to the 10-year Treasury yield. Get a quick update here, make sure I got the latest. Yeah, we're sitting at 2.99, so we're up about 2.5 basis points right now. I think we're in this sideways consolidating range. 316 was the high that was printed back on May the 9th. And then the recent lows, I'm going to say 265 to 275, these two lows. Throw in the 50-day moving average, which is at 264. And that would be the downside as far as I'm concerned. Negative divergence, higher yield, lower PPO. That could mean a 50-period test or a centerline test. We've been working our way down. So more consolidation will take care of it, or we could see the yield drop temporarily. I mean, we came down from that high with that negative divergence pretty quickly from 316 to 280. That was 36 basis points, more than 10%. I guess that's what, 11, 12%. In terms of the yield dropping. So that was pretty quick over 3 days. Now we're bouncing back up a little. Don't be surprised to see more sideways consolidation here. Let's see, economic reports. We had April housing come out this morning. The housing starts. The expectation was 1,765,000 units. We came in 1,724,000 units. So slightly below expectations, and we've had a lot of really bad housing reports here over the past couple of months. We had that housing market index out just a couple of days ago, or maybe it was yesterday, 69 versus the expectation of 75. I mean, not even close. So I was a little worried about this report this morning, and housing starts came in below expectations, but there was a silver lining here. Building permits. And you got to think about what building permits are. Building permits, you don't go get a building permit unless you're expecting to build. So this housing starts is kind of telling you what's happening or what's happened. Building permits is kind of the bigger deal here. Number one, because it's kind of telling you what's on the horizon. And number two, what was number two? I had number one and number two in my head. Number one was obviously showing what's going to happen. Oh, and number two, you don't have to get building permits in all parts of the country. So the actual number of folks wanting to build is going to be higher than this. This is only where they're required to get a building permit. So the building permits, the expectation was 1,815,000, and it actually came in 1,819,000. So it was a little higher than expected. That's with interest rates going up the last 2 months. So I see that as a little bit of a silver lining. Granted, it's a small one, but hey, in this market, we'll take any silver lining we can get at this point. But that was that's basically the economic reports that we're expecting today. So it's going to be focused on, technicals. It'll be focused on option expiration. It's going to be focused on some of the earnings reports that have come out, which honestly, this has not been a very good earnings season. Even when we've beaten, not too many companies have beaten top line, beaten bottom line, and raised guidance. Not a lot, not nearly as many as we've seen in the past. And so with companies being more cautious, we know consumer sentiment's been down for over a year. This is the environment for a recession. And we've already had one negative GDP reading. Of course, we'll get the second and then the final readings the next 2 months to see if they're all negative. And then the big one will come in 3 months to see if we've got another quarter of negative GDP. If we do 2 consecutive quarters, that's your recession. So it's very possible we're in the middle of a recession right now. And when you look at some of the growth stocks, and especially some of the large cap growth that have finally broken down, that's what the market's telling me. It's confirming what I've been saying for the last several months, is that we were going to go from the inflation to the recession. And then market's going to bottom when everybody feels like we can't possibly go higher. And it's all setting up that way, except that last part. We'll see if the market can go up later this year like I'm projecting it will. All right. What else do we have here? Let's take a look. Well, first we'll just take a look at the S&P 500. I like to take a look at this chart every day. This is our benchmark. If you don't know a whole lot about the stock market, I mean, right here, the S&P 500, this is an index that comprises 500 of the largest multinational companies. I mean, the value of these 500 companies, I don't even know what the total value is, but it's many, many trillions. And so this index following this gives you a really good barometer of what's taking place, not just in the US, but around the world. The S&P 500 is an international index. Many, maybe 30 or 40 years ago it wasn't, but it is now. Many of these companies, especially large companies, do business interchangeably around the globe. I mean, they do stuff everywhere in just about every market. So this is a great index to follow, in my view. And that's why I'd normally refer to it. I also personally like the NASDAQ because it does focus on more growth-oriented companies, which I like to trade, which I like to review, analyze. So I also talk a lot about the NASDAQ, but the S&P is kind of a universal. It used to be always the Dow, and still I'll hear some places talk every day about, oh, stocks went up, the Dow Jones. And I'm like, okay, that's 30 multinational behemoth companies. I get that, but that's really not the stock market, not anymore. They have made some changes in recent years to make it a little bit more like the market, but still, I think the S&P is a better barometer, just my own personal opinion. Anyhow, as we rise, a couple things to watch for. Now, like I mentioned earlier, we have futures down this morning, and it looked like the S&P was down, what did I say, 1%? Yeah, a little more than that right now, maybe 1.1, 1.2%. So we're going to maybe pull back a little bit, but you got to watch the 20-day EMA. Because at the latest low, let me annotate this, because this is really kind of near and dear to my heart in terms of technical analysis and the way I view the market. When you hit a low and you see the PPO at that low still pointing lower, and by pointing lower, people ask me, what do you mean by pointing lower? Well, it's going lower. I don't know how else to describe it. It's coming down from zero and it's in negative territory and it's accelerating. That's telling you that the short-term moving average, in this case, the 12-day, it's a daily chart, so a 12-day EMA is going down faster than the 26-day EMA. It's the 12 period and 26 period. That's your default. That's this 12 and 26 over here next to the PPO. And the 9 is just the 9-day moving average of that PPO. And that's the red line right here. So as this goes down, this is going to go down. It's going to be a little slower. See how the PPO is starting to turn up and that red line, the 9-day moving average, is still going down? Because it's a 9-day moving average. It's not, this little bit of a turn here is not having much of an impact yet. Anyway, and a lot of traders, by the way, will use these signals as signals to get into the market. I personally, I don't like that. I mean, if you look here, look back at the beginning of February, look at that cross. So should I have jumped in right there? I mean, it looked like momentum just kept going up, right? Prices didn't. You're below the zero line. You're still, you have negative or bearish momentum. Even if you make the cross, you're still in bearish territory. So this to me was a false signal. I mean, if I bought right here as I was crossing, I couldn't have made any money. And by the time I actually made a definitive break to the downside, I lost a bunch. What kind of a signal was that? How about this right here? There's your crossover. There's your trigger. Wait a minute. That was another false signal. And then finally, here's one. This one actually worked. So I think you got to, be a little careful. Take this all with a grain of salt. I mean, yes, some of them work. Some of them don't. It looks like we're about ready to cross again. We're still in this bearish phase. And I'd love to say that that's the signal. If we get through that, that means the bottom's in. I'd love to say that. But that is not going to be the primary indicator for me. It'll help. When we bottom, we will come back through that 9-day moving average. There's no doubt about it. But just because we move through the 9-day moving average doesn't mean we have a bottom. All right. So here you can see the PPO is declining. Prices hit a low. When that happens, just like when it happened here, this low, we had a new low going down. See where we rallied to? The 20-day, and we failed. That PPO started to hook up and then went right back down again. So here we are coming back up. I think the 20-day is kind of a big deal. Maybe intraday or maybe a head fake. We go above. I mean, we had this head fake above the 20, this one above the 20. Maybe we could do that. But my guess is at the 20-day, if I'm long anything, I'm probably going to be out. And I can tell you Max Pain is above the 20-day. So I'm just another reason why I doubt that we'll get that far. But it's at least worth noting that there is financial incentive for market makers to take prices a little bit higher here. All right. Anyway, so that's the S&P 500 with a little educational lesson based at least on how I use the PPO and price action and the moving average. I think they all go hand in hand. And this is just from years of watching the market more than anything else. When you've got a strong PPO, pullbacks to the 20-day is where I normally like to try to get into stocks. And especially if that 20-day test happens to line up with maybe price support from earlier. You can get kind of 2 or 3 reasons to buy a stock rather than just one. But notice if the S&P gets up to the 20-day, where we'll be. Here was the low between 4,100 and 4,150. Here are 2 lows near 4,150. Again, another low right in here between 4,100 and 4,150. So doesn't it make sense that as we go up, 4,100 to 4,150 should provide some resistance? And then the 20-day is at 4,140. So at least be aware that technically we've got issues to try to get through that 4,150 area. And from where we closed yesterday, that's only 1.5%. So it's not really leaving a whole lot of potential upside. Now, breaking through it, that would be great. That would be the first step to really beginning to repair the market. Let's get through the 20-day. I don't know if it happens here. All right. Other thing I did yesterday, I talked a little bit about international markets. So I'll just go through this one pretty quick. But the DAX, I wanted to show you, this is a 3-year chart of the DAX, the German DAX. But down here on the bottom, this is the DAX relative to the S&P 500. Now, we've had a pretty nice rally over the last 2 months, but we've had rallies before over 1 or 2 months on a relative basis, and and they weren't sustainable. Here was the pandemic was a perfect example where the DAX got hit a lot harder. And then because it got hit a lot harder, it actually worked its way up for a few months and then just rolled back over. Here, the DAX got hit a lot harder, and here it's coming up. Now it looks like it's starting to roll back over again. That relative downtrend still in play, even though we have seen higher lows on the DAX while we've seen lower lows on the S&P. That's why we're seeing this relative strength. However, price action's in a downtrend. Looks like it could be peaking here. And this long-term relative strength has been in a downtrend. or relative weakness, I should say. Anyway, I just want to follow up because I talked about that a little bit yesterday. All right, earnings. Target. Well, let's just say it was not a good, it hasn't been a very good day for a couple of days here for Walmart, Target, some of the names in this space. Target reported earnings. Well, expected to report earnings of $3, reported $2.19. And you can see the stock already had fallen from 255 down to 210. Well, let's pull up the pre-market price here, and you'll see that Target is down $53 to down 25% to $161. Looking on this chart, we're down below everything. This is a massive gap down for Target. I mean, it just reminds me of like the Netflix drop. I just think this one came out of the blue. No one was expecting this kind of a miss. And there's no question it's going to rattle investors. And we've probably got more bombs to drop, warnings ahead, and so forth. But I want you just to remember, as you look at the earnings, Target today, I think Lowe's down 3.5%. They reported. Let's see. We had a couple that were up. ADI, which is a semiconductor analog devices, up 1%. It's been going sideways here. It's actually been doing pretty well relative to the rest of the market. TJX companies up 7%, but it's been on a huge move to the downside. They did come in with good numbers, though. They beat 68 cents versus 60. ADI, by the way, beat $2.40 versus $2.12. Then a smaller company, Triumph Group, TGI, down 21% this morning. They missed. They were supposed to come in at 41 cents. They came in at 39. So it was already under a lot of pressure. It had this little move heading into earnings, and then boom, right back to a new low. I don't like that on a chart. When a stock's downtrending and performing poorly, and then it moves up into its earnings for a few days. And the same thing goes for the flip side. When we're in a bull market and prices are going up, and then we get a pullback right before earnings. If I was ever going to hold into an earnings report, that's when I probably would. A leader that pulls back prior to earnings. Just prior. I'm not talking about for 3 months. I'm talking about maybe for a few days, kind of like this went up for a few days. Anyhow, Triumph got hit to the downside. I'll tell you what, let's do 3 more of these earnings, but we're going to make it the 3 you must see, and we'll try to get out of here on time today, which if you come into these Monday and Wednesday sessions, you'll know is a rarity. But let's start with KEYS, which is Keysight Technology. Actually, let's do this from the, so we know what the current pre-market price is. So we got Keysight Technologies down 1.69%. They actually beat $1.83 versus $1.67, but it's the same kind of thing. I mean, we were in a downtrend. We rallied into earnings. They came out with good news, and the stock's down 1.7%. Not good. Till this trend line breaks, till we get back through the 50 and start trending higher, many of these stocks, I think you just got to be careful. It's painful trying to call bottoms. If you miss, call a bottom too early. I had someone write in to me a couple months ago when we bounced back in March. They're like, how can you still be bearish, after this huge rally we've had with all this bad news? I'm like, well, apparently they weren't into our anatomy of a bear market, cyclical bear market, anatomy of a cyclical bear market session that we had back in February. Because these big bounces happen during cyclical bear markets, and then the next selling is more intensified. And that's what we've been experiencing all year. All right, DOCS. They reported 21 cents versus 14 cents. And the stock down 12%. Yeah, golf clap. 21 cents versus 14 cents. They beat earnings. Great. We don't care. 12% lower. I don't know. Maybe there was other news. Maybe they lowered guidance, but not good there. Last one I'll give you here, and then we'll wrap up. Almost 9:30. Next Gen Healthcare. Now, this one actually, I thought looked pretty good. It is down 6% today, back down to about here. But this is a stock that's been trending higher and just kind of pulling back. I think it's in this little zone here, consolidation. If it breaks below 18.50 and closes there, I'd get out. Otherwise, I think this one, maybe the gap down might present an opportunity. We'll see. All right, let's move over, see if we can get a quick update on the market. And that's yesterday. Let's just pull up the QQQ, see what that does. Yeah, QQQ down 1.5%. Spider down 1.15%, and Diamond, which is the Dow, down just under 1%. So that's where we're opening today. Let's see where we finish it. If we take out those lows from yesterday, that would probably not be a good look on the chart, because we have this series of higher highs and higher lows the last few days. As we start moving toward option expiration day, I would not want to see that taken, out to the downside. Just given the overall market environment, doesn't mean we couldn't bounce back. Remember, there's a lot of money at stake this week, so expect even more volatility if that's possible. Anyhow, have a great day. Rest of your day. I'll be back tomorrow over at Stock Charts TV at 9 a.m. if you want to catch the next episode of Trading Places Live. Have a great day, everybody. Happy trading.